Good evening, everyone. My name is Paul Young. I'm going to do a quick video on trade analysis for Canada for the month of September. Now, in order to frame everything in terms of trade, we have to look at two major facets that drive trade: the Canadian dollar itself, as well as growth rates. So this particular chart showing you how the Canadian dollar has weakened. Now, a lot of that will come back to people thinking that government policies directly attribute to this. That's not necessarily true. They control certain aspects of inflation and interest rates, but the Canadian dollar itself in general is driven by the price of commodities, and we've seen huge drops like 30-40% in the price of commodities, which has forced down the dollar. Now, there's some good and bad things when you start looking at trade. Exports become cheaper, but imports actually become more expensive. So you need to frame that in the right context. Now, like anything else, you're going to hear a lot of rhetoric, and this started during the election from people like Ralph Goodale, basically saying that Canada under Harper had some of the slowest growth rates since the recession. Well, here what you're seeing here is in the left-hand side of this chart, you're seeing exports to key countries, which are basically China, Japan, UK. These are the big countries that Canada deals trade with. Now, on the far right side, you're seeing growth rates. From 2014, you're seeing some very sluggish growth rates in basically mature economies like France, Germany, and all that. Now, those growth rates are determined by a lot of factors in there, and that's a demographic shift. The demographic shift means that during the 90s and the 80s, where we had the baby boomers sending a lot more money in that particular market segment, that's now shifting. So that being said, that's going to drive the value of exports. That's not something the Liberal parties even talked about. They kind of put spins on it, but they don't get into the specific details. And it's very clear that you need to watch the facts beyond that. The other thing that I want you to pay close attention is how sluggish the growth rates. Look at the mature economies like the US. On average, it's only growing about 2.3%. That's hardly phenomenal growth. That is slow or sluggish growth. Now let's look at China on the other hand. China was up to 10%. They're down about 30-40% where they were over a decade. So if China's slowing growth and we depend on exports to those countries, it only makes sense that you're going to see a lot of pressure on exports. Now, September, basically, we've seen some major shifts of what happened in September in exports. Some of the energy benefits started coming back, so there's been some stabilization to a little bit in the energy markets. Oil is still a big export. The bulk of all oil goes to the US, and I'll get into more specifics about that. Now, the other thing that's interesting is that consumer products. Now, everybody's going to say, well, that we don't make consumer products here. Well, we do make certain things here. And that's when we're getting into basically drugs, pharmaceutical medicine products are part of the consumer products area, which again is not disclosed properly. Canada has a very solid biotech and pharma market here, and part of that has to do with the taxation policy. Again, that's never discussed in specific details by the Liberal Party or any sort of government official, so it's very important that you look at the details. This is just the chart that shows you the trend in the up and down swings. So you're seeing that we went to a trough where exports were down in the first part of the year, and a lot of that was driven by a sluggish US economy as well as sluggish European economy. So basically you're seeing that. Now you're seeing the big pickup, and that has to do with a lot more with the exports going to the US because the US economy is growing quicker. Let's look at this. This is the chart that you're always going to hear about. We're in a trade deficit. What that basically means is we're importing more than we're exporting out. Now, there's different ways that you can counter that. Is either you uptick exports by expanding trade deals or expanding the upsell capacity of those exports by increasing more deals, or just working with your products to see which more you can get in terms of exporting those products to a specific market, or you can reduce your imports. Now, that's only the ways you can bring down the deficit. Now, this chart just shows you basically the growth rates in terms of exports from August of 2015. So basically, the exports overall are roughly going to be about flat or a little bit down. Now, that being said, if you look at the overall GDP for Canada, Canada's GDP is about $2 trillion. Exports account for 1/4 of GDP, so that you need to make that understanding is export-driven businesses pay very well. They also drive corporate taxes, so this is where you're seeing some of the pressure on the corporate taxes and payroll. This one just gives you a little bit more of a trend to show you that the U.S. is still the biggest trading partner, but the thing that you need to bear in mind is over the last decade or so, China has risen up quite high in terms of its dependency for Canada. And that's where FIPA, the investment deal, becomes very critical, because you want to have equal access to markets. This just looks at imports as well, again showing you the biggest piece, where China is one of the biggest critical things that's driving some of the exports. Now, I want to really focus a minute or so on this slide. I basically take a look at the major segments, because all you hear is about Canada's economy is all about oil. This will show you exactly that on an average basis for 2015, we're about $2 billion off of our oil. Oil is such a significant dollar value that it's driving down things. But if you look at other aspects for this year, we're seeing transportation. That's a strong automotive sector. Forestry, housing starts in the U.S. are driving that. You're looking at food, commercial products. That's consumer spending's driving that. So you're seeing that other segments have picked up some of the slack, but they haven't picked up all of it. Some of that is due to lost capacity, and despite what you hear about Stephen Harper and from basically on the uniform policies, basically a lot of that has to do with bad policies at provincial levels, like Kathleen Wynne's government. They have driven out export capacity and also driven out companies. When they look at putting foreign direct investment in areas, they're not investing a lot in Ontario to add capacity. They're looking elsewhere to expand capacity. You can also take a look at Rachel Notley's policies in Alberta, where you're also seeing a reduction in foreign direct investment. So that being said, it's going to be a very tough road for Canada on the export side unless oil prices rebound, unless there's other ways of policy to stimulate that foreign direct investment in to help support the economy. This just basically shows you a little bit about volatility with growth. What I basically did is Export Development Corporation is a good area to take a look at. They support exports. They're kind of like a government agency that provides help for companies exporting into new markets. They provide accounts receivable support or other type of support to get exports to market in foreign markets. So what this is basically showing you is it's showing you things like other consumer goods, energy products, machinery and equipment, ag, forestry, etc. Then it's showing you where their strongest is, where the weakness is, right? Well, we all know energy's been a big struggle point this year, but it's showing some areas where it's improving a bit. Like look at energy province, Newfoundland. Well, Newfoundland has offshore oil, so it seems to be helping Newfoundland in terms of the oil prices. They seem to be able to export a bit more. If you look at machinery and equipment, Alberta's actually done well in that area, it seems. If you look at automotive, that's where Ontario's the strongest, and same with other industrial products. Forestry products, this is where we're getting in lumber, you're getting in pulp and paper. Mostly it's lumber right now that's driving this because of the housing starts. This just shows you the trend versus dollar, so you can kind of see the currency and the trade imbalance, what's happening with the US dollar, relative strength. Now this takes you a look at the provinces itself. It tells you what sectors are the major contributor, which sectors are the weakest. So if you look at Ontario's case, in the month of September, the biggest contributor was other consumer goods. Mostly what that's driven from is pharma sales. And as I said, Canada's got one of the strongest farmers markets, and Ontario has a very strong biotech pharmaceutical market. You look at machinery and equipment, look at Alberta. Now you look at Saskatchewan. Okay, so certain areas like heavy equipment and machinery are down, but you're seeing uptick in areas like agriculture, consumer goods and machinery in different provinces, and that's something you need to bear in mind. This is just comments from Bank of Nova Scotia in terms of what's happening with the trend. So other words, what I'm trying to say here with the overall graph is exports have performed reasonably well despite the pressure of global conditions, and that's what you're seeing here in terms of trade balances, everything else, that Canada's done reasonably well for the first 9 months of this year on exports. Now, are we going to see a big huge uptick? No, you're probably going to start to see the same similar growth to the remaining part of the year. But next year probably we'll see maybe 2 to 3% more growth in exports, and so on. Now that's all going to be driven too by some of the policies in play right now. One of the things that likely will drive more exports into Vietnam and other areas is the new Trans-Pacific Protection Agreement. We'll see some of that come into play in future years. We'll also start seeing the South Korea deal pay dividends down the road. So a lot of stuff was in play before there was a change in government. We need to watch what happens with current government policies that may drive some of this foreign direct investment. Some of it's going to be the carbon tax or climate change policies that the Liberal government's planning to do, and that may directly impact foreign direct investment. The other thing is the government's focus has to be cross-section of the economy, not just green energy, but looking at other aspects of mining, to pulp and paper, to forestry, to all those different sectors to support the economy. Thank you.